Welcome back to another top-notch video. This week, guys, we're going to be talking about the week of January 1st through January 4th. We're also going to be kind of going over our yearly review for 2018, as well as what the markets have been doing in the fourth quarter for 2018. We did take a break for fourth quarter, and crazily enough, it was just a crazy quarter. The one quarter we decided to take a break, it goes crazy. But that's the markets for you. Markets can tend to do anything from ups to downs to things you would not believe happen. So, as always, we are a channel that goes over the TSP as well as general large markets. So we go over, if you're a TSP investor, we go over the CSI and F fund, or if you have a ROTH or brokerage ROTH account, we go over IVV, which is the S&P 500, the VXF, which is the Dow Jones or small caps, EFA, which is international markets, and the F fund, AGG, which is bonds for the most part. So basically what we do is we're going to go over all of what we have for this week, and then you guys can ask questions in the comments below. Hope you guys enjoy. So one of the first things we want to look into is TSP Talk. There's a guy named Tom that does some comments there. So just looking at some of his comments and whatnot for the week. As you can see, moving into the new year, we did take a pretty nasty December, and we are starting to bounce back from that. But we are going to be seeing some resistance here at the 20, 50-day, and possibly 200-day lines. So we did have some good bounce back from that. But we have a lot of resistance ahead for the S&P 500 or the C fund. So please keep that in mind moving forward. As you can see, our line's about to cross here again. We can go more in depth and detail later. The S fund also has the same thing. We're hitting that 20-day moving average. Could start to see some resistance here, but I really think we're going to start seeing some real resistance when we get close to this 200-day moving average again. So just keep that in mind. As well as EFA or the I fund, international stocks, bonds, and markets. We've been in a bear market now with this one for a very, very long time. It's hit that 50-day moving average multiple times and continue to go down. And I don't know when we could see this pop back. I wouldn't be interested in this fund until we can see it poke its head above the 50-day moving average. So we're just going to stay out of this fund for the most part for the year. And then, of course, we have AGG, which has just taken off for the year. We saw the 50-day moving average move above the 200-day moving average. So bonds are starting to outperform stocks here a little bit. Something to keep that in mind as we're moving forward. That started to happen about mid-December or November, and it's continued to do that ever since investors have been staying away from stocks since we've had these big kind of loss periods and whatnot. So that's kind of our general overview. Stocks for the week, as you can see, we gained close to 1.5%. If you were in the same funds we were all in the S fund, so we gained 1.8% this week, which is a very, very good gain for the year so far. I'm sorry, 1.8% for the week and for the year. Is the first week of the year. Sorry, a little confused there. We had a very good day on Friday, and we'll just continue to watch this as we go forward. Now that we've kind of done that, let's go into some of these other updates, some of these other things that we found. So what we found is this is a TSP. This is Grow My TSP. What they're saying on here is they see the C fund basically hitting this 200-week moving average. This is a very, very long-term chart, so just keep that in mind. And then this is the 10-year trend line just below that. They think that it could possibly come down to this line and hit that and bounce back up. We haven't seen that just yet. I like the 200-day moving average. I think it might come back up to that 200-day moving average before it comes back down to this line, but I have no doubt in my mind that when charts have these large volatility periods, they tend to bounce up and down. So I could definitely see this coming back up to the 200-day moving average, hitting that, and then maybe bouncing back down to the 200-week moving average or the 10-year trend line for the most part. As you can see with our indicators, our WM percentage and our RSI percentage, we have these very low indicators, so I think we could see a rebound up to that 200-day moving average based off of some of these indicators we see here. The S fund's in the same boat. We're kind of hitting that 200-week moving average, and kind of markets are digesting that again. Keep in mind we hit that last time in 2016, and we had quite good markets from there, so just keep that in mind. I think this is, again, I think long-term we're looking at some very, very good charts and percentages, but it's going to take a while to get back to where we were. As you can see here, it took about, I would say, almost a year to make it back to that 200 that high back in 2015. Almost a full year to make it back to that point. Oh yeah, I would say just about a year. EFA or the I fund is right around the same point. Even though I have less confidence in this chart, I would just stay away from this chart for a bit. But another thing to keep in mind is when it gets down to this 10-year trend line, every time it's gotten down to this 10-year trend line, it's bounced off and had pretty significant rebound. So this could be a very good time to start investing your money in capital into some of these funds. So just keep that in mind. But again, I like the CNS fund a little bit more than the I fund for the year, and I'll show you why that is. Other than that, that's all we really had for this. That's Grow My TSP. They have a website, very good, and you can look at that. Moving more into the general charts for the most part. So let's look at IVV to start, and I'll zoom up for you guys so you can kind of see that. So with IVV, as you can see, we are moving against that line right here, the 20-day moving average, and then the next one will be the 50-day moving average, and then the 200-day moving average. So 20-day, 50-day, and 200-day. This is starting to look a little concerning, this downward trend with the 200-day. Every time there's a downward trend with the 200-day moving average, it tends not to do very well. But we typically see these charts come back up and hit this 200-day moving average if they're going to move lower first. So keep that in mind. I really think we have a good chance of this chart to come all the way back up to the 200-day moving average, or just quite below it, right around the 270 line, to before we could see this possibly move lower or start to make a bottoming process off this fourth quarter. So keep that in mind. Moving on to the S fund or VXF, we see a very similar picture. I don't really see a whole lot of difference with this chart. Same thing with the C fund, so nothing really to say there. With EFA or our international markets, we're not in the same boat with this, just because every time we've come up against this 20-day moving average, we've seen resistance back here in November and December, and even all the way back, I would say just all the way back, we've seen it's barely risen above that before it's headed back down. And now that we have this line below it, I just don't see it bottoming just quite yet with this fund. So keep that in mind. And then last of all, for our general overview, we'll go over AGG. With AGG, we saw a significant uptick with charts. So we are almost to the 1.7 line. That is a very big deal. We see the indices, the moving average, start to turn up here. So bonds might be a good place. And like I said, usually after a big downturn, bonds and stocks tend to go back and forth and outperform each other. So a very good balanced portfolio might be a good way to go forward, just to try and capture the most gains as possible, but that's really based off of your investing style. Moving on, let's look at the charts. So with all the volatility, it's been really hard to look at basically just our weekly charts. It's just been a ton of volatility in here. Basically, we took, like we said, fourth quarter off right about here was when we left the 28th of September, and we saw a significant downside. We made one last move in September. We took all of September for the G fund and decided, basically kept it out of the markets in the G fund, and then we decided to put it in the last fourth quarter when we couldn't manage it, just to have the markets manage it since we were so far ahead of markets. And that ended up faring not too well for us, obviously, in this last quarter. As you can see, we have our blue line below our red line here. Our weekly charts we're coming out here, and then we had a fake out here, and where we lost a significant amount more of capital in December. With this much volatility, and we have these charts up and down, we like to look at the 2-day chart. And with the 2-day chart, we can kind of see that we are coming out of a very negative period for stocks last month. Starting to move back that period of where things could get better. Like I said, this is where it really gets to the point where I think we could get to the 200-day moving average. Once we start to see this move back down, though, we start to have declining bars, and this blue line starts to head back under the red line like we see here. We'll most likely pull out, just because we want to try to make some and capture some of that gain in this upcoming first quarter and try to get ahead of markets. But we'll see where things go. And then obviously we have the 4-hour. We like to look at the 4-hour a little bit. We just had a fake out on the 4-hour. As you can see, we just headed back up, so that's a very positive sign if you have cash in IVV or the C fund. Moving on to VXF, or the Dow Jones / small caps. We see kind of a very similar picture here. Weekly charts are moving up, so that's a good place to put money long term. And with a 2-day, we are just about ready to cross. That's a very good time to be investing money. Hopefully we get a better cross than our last cross here. And we'll see where this ends up going. Again, here is our 4-hour. and as you can see, we had a little bit of fake out. Fake outs tend to last a couple days before they head back down, so it's very positive. We're right in the middle of our Bollinger Band, so we have lots of room for upward or downward movement, but most likely upward with seeing this 4-hour chart. And again, I think we could see this move all the way probably to our 200-day moving average before we get that kind of rally, maybe through the mid-January before we see a decline in these charts again. With EFA, we are seeing a lot of volatility here in these charts. This is the weekly chart. We typically don't see this in a weekly chart. We always go from bottom to top and then top to bottom, but there's been a lot of volatility in trying to get this out. And with this, we go to the 2-day chart, and as you can see, we did cross here, so that's a very positive cross. But with this being in a bear market, we're just not all that interested in EFA at this time. Obviously, we have some good movement here as well, but I'm just not as interested in EFA at this time. With AGG or bonds, the F fund, we are seeing very, very positive movement. A time you would have wanted to move in this fund was probably around end of November, and that would have done you very, very well. Unfortunately for us, we were not around for end of November, and with our charts moving up so much, if we look at the 2-day chart, it's starting to decline, so we missed our opportunity there for AGG because we were not in that. So we'll stay out of bonds for right now, and it might continue to rise or whatnot, but we're seeing a decline here, so most likely not. And as you can see in the 4-hour, we're starting to get really close to that line there, and we're starting to lose energy here. So that's basically our charts for the week. Where we're at for our funds is right now we've diagnosed everything and whatnot. We've had our funds in there all the way since the 28th of September, so we've taken quite a hit. We did gain some capital through the last 3 months, putting some more additional monies into those accounts, but everything is currently in the S fund. And we'll most likely be moving things out of the S fund soon as we see target opportunity, when you see those 2-day charts start to decline a little bit, or we get close to that 200-day moving average. So that is our plan of attack for January moving forward. That being said, let's kind of move into some of the yearly stuff that we had. So as you guys know, for the fourth quarter, we took a break. We took a break from the basically from just TSP in general, because we had to move from a certain location to another location, and with that, we were right around this September point right here, September 28th, right around this point. That's where we took off and decided to let markets just deal with the account. Since we were ahead of all funds for the year, we decided to let our money kind of ride it out for the fourth quarter, and usually the fourth quarter does pretty well. And how did that just did not work all that well for us. This is from CCM. They have their own website. You're more than welcome to check them out. But this quote's from Sam from Market Watch, whatnot. And basically, what it reports is since World War II, only in 1 year, 1990, did the markets have 2 10% plus corrections. Now, knowing that going into the fourth quarter, having a 10% correction back in February, and having all this nice support moving up throughout the year, we were not very concerned about leaving our money in the markets and not watching it for a couple months, because the percentage of the probability of having another 10% correction was very, very low. And so we were just, even if markets declined a little bit, it wouldn't have been that big of a deal as long as we didn't miss out on a 5 or 10% gain in that last quarter. And with the economy doing so well, we just decided to leave where it was. Obviously, that did not work out very well for us, and we ended up having a second 10% correction in a single calendar year. And the odds of that happening based off of only being in 1 year, 1990, was a 98% chance that would not happen. The probability was definitely there for just leaving your money in the markets and just letting it go for fourth quarter. And that's exactly what we did. That was our reasoning behind that. And it just, guys, markets are markets. They can do whatever they want, and we've always said that since we've had this channel. And obviously, we took a hit for it. So, since 1990 was the last year that we had that correction, let's take a look at that year and see what happened. In that year, we had a correction early on in the year, sort of how we saw it early in 1999. And then we had a new all-time high sort of in the summertime. And then we had another 10% correction. When you have these 10%, 11% corrections, you put a box around it, kind of see where the markets are at. Where are we at? I think we're somewhere in here. I think we took quite a fall here, and now we're going to see this kind of retest the box. We could see it come a little bit lower, or we could see it move higher. Basically, I think it's going to take about around 5-6 months to really see where this correction is going to go, as if it's going to turn into something of a bear market, or if it's going to turn into higher highs later on into the next year, of maybe towards the end of 2019. We don't really know, but we need to watch it very close. At this point, we have taken basically a downturn of capital, and we don't want to lose any more capital. So what we're going to do is we're going to try to get, like we do every year, try to get ahead of the markets a little bit. And then once we're ahead of the game, our strategy will change. Obviously, that didn't pan out for 2018, but hopefully it pans out for 2019. And again, I think we're in this very consolidation kind of phase. Once you have a large loss of capital, usually markets consolidate as the market is trying to make a decision overall of where things should go. And I think what we're going to see here is probably come close to the 200-day moving average, and then we'll probably bounce to the same area or maybe a little lower before we end up continuing higher if it continues in this bear market or this bull market, or continuing lower if it turns into a bear market. Where did things happen after 1999, after we had this 10% corrections? So obviously, this is the only year that this happened. We had a 10% correction early in February and towards the end of the year. We had some bouncing around for about 5 months, and then once we had those bouncing around for 5 months, the next couple of years, 91, 92, 93, and into 94, we had a 64% gain. So obviously, we have to just be open-minded to everything. Just because all the news and everything says it's a bear market, it's going to turn into a bear market, isn't always the case. We always have to have that open mind and consider all our factors when looking at the markets. Like I said, we'll be looking more towards the 2-day charts to kind of stay on top of things, and hopefully continue to do much better in 2019 than we did in 2018. That being said, how did we do in 2018? If you guys are interested in knowing what we did and how we did, we will take a look at that right now. So these are the returns for the year of 2018. Obviously pretty nasty. The only things that were positive for the year was the L fund, which was up 0.5%. The F fund, which was not even up 0.25%. And then of course the G fund, which made about just around 3%, but it was still below, right around inflation for the year. Now, how did we end up doing compared to that? Obviously, we want to beat our stock indice funds is our goal, and obviously try to beat all the funds for the year. So here is a yearly review for Top Notch Channel. As you can see, we took that 10% correction in February. We mitigated it by moving about 50% of our capital away from that, and instead of taking a 10% hit, we ended up taking a lot less than that. And that was very good. We had a very decent risk mitigation move for February and March. Then we ended up going into basically the summer, and we had some great. We left our funds basically alone into those stock funds. And right around September, when we were right around 12.75%, we decided that we were ahead of all TSP funds for the year. And we felt pretty good of where we were at with our position, with 98% chance of market probability saying there wasn't going to be another 10% correction. We felt very good where we were at, but obviously we cannot see the future, and we took a couple months off due to a break, and we ended up taking a massive hit. We left our funds in the stock funds, and for October we took exactly a 10% correction on our funds. For November we made a little bit of that back, and then for December, we ended up taking another 10% correction. Pretty amazing to have that happen all in 1 year. So we did end up losing funds for the year. We were at a drop of negative 6% for the year, which obviously is not something you want to have done. But when you look at that 6% for the year, minus 6% for the year, and we compare it to the I fund or EFA, negative 13%, or the S fund where we had our funds for the majority for the year, we ended up doing better than what the S fund was. Instead of taking a 9% hit, we ended up taking 6% hit. And doggone it, the S&P 500 ended up beating us for the year by 2%. So in the end, the S&P 500 was the best overall for basically our stock funds. And then if you would have been invested in bonds all year, you would have basically broke even. Or if you would have been in the G fund, which doesn't typically beat inflation, you would have been at almost 3% for the year. So the G fund for 1 year out of very, very many years ended up being the best fund. That is not usually the case. Very, very rare to see that happen. We were in a very interesting year. Like I said, in 1990 was the only other year where we've seen two 10% corrections. Like I said, it'll probably take 6 months for markets to kind of figure things out. I'll be with you guys as well to kind of diagnose what the markets are up to and what they're doing. And then once that is complete, hopefully we continue on with our bull market. If not, we will safeguard capital and we'll continue onward. The biggest thing with this is we don't want this 6% to turn into something like a 2008 where it was a negative 40% or drawing down half your portfolio and whatnot. So I don't really consider this super terrible. In the end, it's really not that bad. We'll continue forward. Like I like to say, even if you take this loss for the year, and you're still buying funds as you're still in your TSP and you're putting money in every month, think of this as a discount. Think of stocks like they were back in 2017 and you're buying at those prices before stocks rise again. So you can think of it like that. But again, yeah, our goal is not to have negative numbers. So I apologize for that. I really think we were doing very well until we stopped doing some videos. Hopefully this year we won't stop, and then that way we won't take as much losses as we did this year. But like I said, markets are markets, and you never know what they're going to do. And when you get complacent, when you get comfortable, that's when things go to crap with your accounts. So it's all good. We will continue forward from this point and continue to do what we do here on this channel. And I predict we'll do much better than what we did for this year for sure. So that being said, the only other thing I want to tell you guys is if you were in the military, I chose to opt into BRS for the year. And what did that do for me? I want to show you guys kind of my 2017. I ended up contributing about $8,600 to my account. 2018 with the BRS, granted I did up my percentage. BRS did a significant amount. It increased my portfolio by a lot. And the number one thing to making money in your portfolio is not percentage of how much you make or you lost, it's contributing. That's been found out many, many times. So the BRS, I think, is a very, very good option. Unfortunately, you can no longer opt into it, so I hope you guys got into it last year. We had a video on our channel about how to opt into the BRS. So we'll see where that goes in the future, but overall, BRS has been a very, very good, contributing about 5% extra to my account to what I already contribute. So with all of that, if you guys have any questions about my returns for the year or where we're headed forward, we'll continue on. But like I said, I think based off of probability and where we're at, I think we're going to see the funds come up close to that 200-day moving average with maybe some resistance in there and then head back down to test the lows again. So we're going to try to capitalize on that return for the year. We are positive so far for 2018. And like we said, we just want to get a few percentage points above those markets, and then we have the advantage over the markets. But we'll have to wait and see until that happens. So we are in the S Fund until future notice. We are putting all new contributions into the S Fund, and we'll continue on with that allocation until we see something that is a warning sign to us. Really hope you guys enjoyed the video. Please like, subscribe, or share. Really appreciate your guys' comments. It's been an awesome year. I really enjoy doing this channel. It's been different but fun, and it's just a fun little hobby to do. So I really hope to see you guys stick around. If your friends have TSP or a brokerage account, or you just like watching stocks, I would recommend checking out this channel every month or every week. And again, that's another top-notch channel. That's another top-notch video. We'll see you guys next time.